If you are expecting that you will learn by just watching videos or attending, then it is misunderstanding. You will need to study more. You will have to watch assignment videos. Just watching 1 hour lecture or 2 hour lecture, it is not sufficient. It takes a lot of time. My role is to guide what to see in that things. It is impossible to explain financial statement analysis. It takes 6 months to explain this all things. But from the investor point of view, I think this is enough. So you see now Dr. Priyanka coming back to Priyanka and see the importance of ratios. So the health ratios are debt to equity, D ratio. We say it should be less than 0.3. What if it is more than 0.3? You have to do further analysis to find whether there are physical assets to justify whether sales is rising. Quick ratio, we say it should be more than 1. Because this quick ratio represent how whether company will be able to make payments of vendor immediately or not. So this is called as liquidity ratio, and this is called as solvency ratio. If debt increases very high, it can go bankrupt. Anil Ambani took huge debt, and that was the cause of death. In fact, the debt come before debt. Okay, most of the company which die, debt will be always there. Because debt is the last attempt to survive the company. Okay. So company's main feeder is a customer, which gives sales. If sales goes down, what company does? Company raise the money from the equity investor, but equity investor are not interested. Then what company does? Company take the loan and try to sustain, and debt start rising. So sales goes down and debt goes up is the catch where company close the operation. Okay. Next is GA. This GMR. M is margin. Okay. So these are the margin. What are the margin? OPM margin and NPM. For good company, margin should be at least 10%. Okay. We prefer that it should be 15%, but that is good. But at least 10%. Both OPM and NPM. Next is ROCE and ROE. Now these are not a hard and fast rule. For just understanding purpose, when you do the company analysis, then you will understand automatically pattern of different companies. It should be at least 10%. If it is 20 plus, it is good. It should be 10%. So this is margin, this is a return. Okay. Then growth rate should be at least 10%. I'm giving 10% just for easy memory. Okay. Otherwise, it is not rule. All ratios about 10%. I'll explain why 10% kahan se aaya. Growth rate. Sales growth rate, EBITDA growth rate, all should be at least 10%. It should not be less than 10%. Why? Because GDP is the average growth rate of country. If all company combined together with informal business, it represents GDP growth rate. In addition to that, there is a inflation as well. Suppose if any company shows sales growth rate of 5%, whether it is because of increase of prices, inflation, or production of goods is increased, we can't tell it. So company growth is not just increasing sales, the production or quantity of goods should increase. Okay. So if inflation is 6% and company sales is growing 5%, you may say it might not be producing more, but just because of price it has gone up. And if any company which growing less than the GDP growth. Now again, this is not the rule because some companies, established companies, cannot grow because they are very big. But for the medium growth and mature company, we say if any company is growing less than GDP, we'll call this as a G1 company. It is growing less than the GDP. We consider 7% as a GDP growth rate. Poor growth. Then low growth, twice of GDP. Medium growth, thrice of GDP. High growth, 4 times GDP. Very high growth, 5 times of GDP growth. And rockets, 6 times of GDP growth. Why GDP is taken into consideration? Because in an emerging market, if GDP is growing, probably companies will have more potential to grow. Companies in USA, you will find that very few companies can go with the 4x GDP or rocket companies. These are rocket companies. 6G company can just multiply by 7 and you can find that if any company is growing year on 40, it is a rocket company uh, and it is growing rapidly. So what growth we say? Either sale growth or profit growth. Okay. So we parameters, we say that health ratio and growth ratio. Growing, based on that, you can divide companies into G1, G2, G3, G4, G5. How much company is growing? Okay. But the problem with that, this knowledge is available to everyone. Everyone can find the growing company. What happens then? This company has a high valuation as well. High valuation. People expect growth. They are high valuation. So then next parameters come into picture is the valuation. So you check the profitability, health ratios, shareholding. I'll explain shareholding before we go to valuation or else we may forget. Okay. So shareholding, what you have to see shareholding, the parameters red flag, that promoters shareholding is stagnant or slightly increasing but not going rapidly down. Promoters should not sell the shares. That is a red flag. There should be some FII component, maybe at least 10% FII, 10% DII. That means the big players are in the game. And public should be less. We say less than 30% public shareholding. By using this criteria also you can avoid the companies. I'll show the first public holding more than 70% and you'll see that why it is important to understand. So this is a public shareholding more than 70% and you see that most of the companies are tiny. Okay. These are tiny companies. They are not sales. You can see that sales is almost zero. Suppose how much is the public shareholding here? It will be more than 70%. So public shareholding means retailer shareholding should be less. Okay, it should never be more than 50. So this is a Gotia company. There is the shareholding. Okay, 83%. Okay. Now you may say why DI is, there must be some, they might have trapped. But on shareholding, you have to see that DI shareholding is there. Increasing the FII DI holding is the positive sign. Okay, so the FIIs are increasing, but this data is available every 3 months. So it's a delayed data, but nevertheless, you can see trend over the period that FIIs are DIs are investing and public shareholding is less. So what this company pattern is, when public shareholding is very less, 10%, it means it is dominated by the big player. Okay. So such stocks are little stable. They don't fall fast rapidly because liquidity is much less. I will show one more MRF. One more component is share pledging as well. Okay, okay, see this. Promoter, no change. FII is there, DI there, and even public, there is some institutional. So essentially what you are doing here, trying to find it, whether this company is invested by mainly institutional or retailers. So go with the institutional, not retailers. These are all uh, uh, retailers dominated companies in the promoter shareholding. Okay, so let's go to the valuation parameters. Now the valuation is we use it as a timing tool, not a selection tool. The biggest challenge for the valuation is people read books uh, which are written for the fund manager, where they have lot of money to invest. Retailers do not have. Another, that valuation of unlisted company is a different from the listed company. Fund manager has have to accurately do the valuation of unlisted company, and they are the offer giver. Retailers are not the chooser, they are the retailers are the taker, price taker. So you really don't have to waste your time to understand the complicated methods of valuation, because you are, even if you find the good valuation, you are not going to invest 1,000 crore rupees in industry. So but be aware what big player do, then you can take some information. So listed company valuation can be done by simple tools like P ratio, PEG ratios, and CAGR, which we use it. And unlisted company valuation can be done by the discounted cash flow comparison with other companies or some other method. Okay. So how valuation is done? Now we are price taker, retailers. We cannot determine the price. So what we can understand valuation from the point of view that there is a market price, and whether that market price is below or above the estimated price. That is the understanding valuation for retailer perspective. So now that estimated price can be intrinsic value, which is calculated based on the discounted cash flow. Sometimes they call fair value or some other calculated value, some sort of assumption and calculation done to mention the fair value and decide whether market value is above that value or below. For example, this indicator we created, I shown in one of the video as well, that Nifty gives approximately 11% return, CAGR approximately. And if we draw the that CAGR as a central line, okay, so Nifty this return goes up, and this central line is average CAGR return line. And if you extend in the future, this is CAGR line, average return Nifty goes. And then real Nifty fluctuate around this. This average CAGR we calculated from the 1st January 2026 to 26 1st January 2006 to 2026, 20 years CAGR. And we draw this line and we find where is the Nifty current Nifty price as compared to that calculated value. And what we see that Nifty is oscillating or hovering around that CAGR estimated line. So if it goes to below 10% of the calculated value, we say this is undervalued. So undervalued, undervalued, undervalued. If it goes up, overvalued, overvalued. So exact calculation is not required. It is a very simple common sense. Uh, if you watch This I have not shown in the assignment video. I'll show, I'll put in another video. But the idea is that you decide some central value and see whether it is going up and down. It can be done by multiple ways. So how to decide the central value? One example I shown that central value, we can see that average CAGR and how it can extend to in the future. Second, we can calculate the discounted cash flow, and this is very important topic. I suggest that you learn this because this is a central of asset pricing in bonds and stocks as well. Although we don't have to do this, but it should be better to aware what people do. Okay, so discounted cash flow is very simple, and it is derived from the basically bond pricing. Okay, suppose you invest into the FD 100 rupees, 100 rupees FDs. Bank give you 8 rupees next year, another 8 rupees as interest. But after 2 years, 8 rupees 3 years, and in fourth year it gives 8 plus remaining principal back 108 rupees. So this is a 1 year, second year, third year, fourth year. Okay, so what you do the calculation of present value, calculation of future cash flow. Okay, first you take the 8 rupees divide by, and now this rate is called as discount rate. I had mentioned this in a assignment video. Discount rate can be inflation rate, expected return, or your cost of capital. Suppose if you see that inflation rate is 6%, so you put in the formula. So let's calculate the cash flow present value of this. 8, take a pen and paper, calculate 1.06. 06 means 6%, raised to 1, first year, 1. Okay, plus again 8 divided by 1 plus 06 raised to 2, because this is a 2, plus 8 divided by 1 plus 06 raised to 3, plus 108 divided by 1 plus 06. 6% is the discount rate, raised to n, that is fourth year. And you do the calculation of all these things, and whatever the amount is, it's called as present value. So the present value is the discounted cash flow, future cash flow, and whatever the amount is considered as a discounted cash flow. And that is how the same funda they use for the bond pricing, and for bond pricing they came with the calculation that we can use for stock as well. But there are a lot of issues in this calculation. First issue is, how do we guess the future cash flow? And that is estimation by the experience based on your economic and business knowledge. Okay, so that is one challenge. Then what type of discount rate we use for the assumption calculation, and what will be the terminal value? So this is a complicated process, and beginners cannot estimate future cash flow, because for that you need a lot of industry knowledge, company knowledge. Now discount rate, you can see that what is the importance of discount rate here. Suppose in market interest repo rate increases, or bank interest increases, what happens that the models of valuation here, the discount rate increases and the stock value goes down. So that is why when interest goes up, stock prices goes down. So this is the relationship of interest rate and the stock valuation, because their valuation goes down because of this factor. That is discount rate. But this discount rate word is abba jabba tabba. That means it's very difficult to explain what is exactly discount rate. Discount rate, you can discount whatever you want to do, whether you want to discount inflation rate, market interest rate, or your rate of return is I want 12% return, and so on. Okay, that's why this valuation is completely theoretical game. It does not have practical application, but it should be aware that there is something called a discounted cash flow, and this is how they calculate. Terminal value is end value. In a bonds, we know terminal. What about stock? It is not known. So that is why there will be hundreds of people will talk of different uh, values of discounted, but still they have some theoretical base. There is another way of same but based on the dividend, and it is calculated dividend per share. Okay, and discount rate, again discount rate here. Okay, and dividend growth rate. So now this discount rate, you can consider that I want 12% return from the Nifty. Okay, and then 6% is a growth rate. Every year company is increasing the growth rate. So you can say that 12% is the discount rate, that is my expected return, and 6% is the dividend growth rate every year, and current year dividend is this. And if you solve this, the price should be, the fair value should be like 833 of that particular stock. Okay, people use another parameter for the discounted cash flow. So they use free cash flow. So the free cash flow is calculated based on the operating cash flow and capex. Okay, so instead of dividend or PAT, they use a free cash flow. So these are the complicated theoretical basis of the valuation. Just you should just be aware. You don't have to do it. What you can do in a practice, that valuation you can do by quick method, thumb methods, by using these ratios. P ratio, take the let's say 10-year data. You compare with the same company, whether P ratio is P valuation, this is a PE ratio. Is it high or low as compared to past? Okay. Now PE ratio, there is a price and there is the EPS as well. So if EPS goes up, P ratio also goes up. If EPS goes down, P ratio goes up. Then you remember this. Okay. But you see the P ratio is here. So in general, it is said that up to 20 P ratio, stocks price start reversing. Now I'll show the another example of P ratio, valuation ratios. So this is a P ratio of maximum. Now you see that this is a cyclical stock. This is a earning per share. Let's say market cap. Okay, so let's see. So this is PS ratio. I'll show first PS ratio, then P ratio, because sales is at the top line and then bottom line. This market cap to sales is the PS ratio, price to sales, price of one share and total shares divided by number of shares. So you see that this is the cyclical company. Sales is also cyclical and PS is also cyclical. Okay. Now since 3 years, you can say that the last 1 year, sales is slightly increasing and PS is also increasing. Okay. So if you check longer period, so when P ratio, PS ratio at the previous bottom, we try to mark it. For example, here, low P ratio, okay, PS ratio, and this is P ratio. Whenever there is a loss, P ratio has no significance, because if it is loss, the ratio cannot be useful. That's why there is a gap. Okay, we'll show some other MRF. How we use the valuation, that's why I'm showing. Okay, so this is a valuation. PE ratio based on the price to earning. And so in the previously you can say that valuation will remain around 15-20 here. Okay, 20-20. As of now, it is 24. Okay, and last time it reverses from the. So is it at good valuation? Yes, it is good at the valuation, at least at present. You have to see entire picture. It is not just one parameter, but the valuation is at lower uh, zone. Check the margin as well. Okay, see that sales is going up, margin also fluctuating. This is mature company. One more PB ratio. So PB ratio again. Okay, so PB ratio fluctuate. The way price fluctuate, definitely PE ratio, PB ratio, PS ratio will fluctuate. So what we do, we use the technical analysis knowledge. We enter at the support of the PS, PB, and P, PS, 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 PE, and PB ratio. So this valuation game we use by this way. There are three valuation parameters here. PS. What is PS ratio? This market cap sales is the PS, price to sales. Then PE and PB. There is one more EV, EBITDA, forget as of now. Okay. So this chart will be helpful to us to find undervalue. Be aware that value investing is buying undervalued stock. But undervalued stock opportunity are always available only in market crash. So if you are trying to catch the bottom, you don't have to go into the price chart. You look at the PE chart, PB chart, PS chart, and do the technical analysis for entry. So the valuation we use for a timing skill, not the selection skill. Selection skill we use the other parameters. Okay, MPTDS is the one criteria. It's very simple. What we do in MPTDS, we check the companies with five parameters. Let's say Colgate or any company you use Maruti. I will show MPTDS criteria in 2 minutes. It's a very quick, even children can do. Maruti Suzuki, what you see, market capital should be more than 10,000 crore. Okay, write down more than 10,000 crore. Then go market cap, then price. Click on the price chart, click on the 10 years. It should be going up. Slight here and there, okay, but it is definitely going up. So market capital, P is the price. Then TDS. So where you go, TDS first, see the sales. Sales going up. You can see that year on year it is going up. And then next is T&D, go to the cash flow that is available in the operating is the tax. This tax should go up. Forget the negative sign. It should go rising. And last is financing activity. This dividend will increase. So we will discuss this MPTDS and MD Sport in a separate video. But if you want to do quick analysis in 30 seconds or 1 minute, any company, this MPTDS, it's very popular since 2017, since we started WealthCon. This MPTDS is the fastest and the most popular, most used criteria. Even if you do not know all this analysis fundamental, if you able to do the MPTDS criteria, you are going to select good companies. How? First, it should be market capital and should be more than 10,000 crore. Then price of the company, share price, MP tax, then and sales. Just such a simple. Price should be going up, tax should going up, dividend should going up, sales should going up. And this will show you mature companies or most of the late growth companies. It will not be early growth company. You just have to see the trend, price trend, whether it is going up or not. Slight here they are okay. COVID dip show, forget. And if you find that all these are valid, then we say that it is valid, not valid, and watch list. So what I suggest in a group, a G10 group, make a list. You just go to the screener, run the screener, here. Market capitalization more than 10,000 crore. You are getting 562 companies. You just export, it is download, and each one of you take the 50 companies and do the MPTDS analysis and make a list which companies are MPTDS positive. So even if you do this quick analysis, you are going to select the good company, because MPTDS criteria is based on the high specificity. Assumptions are very simple. TDS. Now, tax and dividend represent profitability. Profitability represent sales, and profitability is represent the increasing the share price. So घुमा फिरा के बाद सिर्फ profit, the bottom line is a profitability. Everything boiled down to profit. Whether profit is going up or not, that's it. This all other parameters tells us this, whether future profit of company is going to increase or not. It based on the past data, if it is increasing. Profit can be manipulated, but tax and dividend are difficult to manage and manipulate, because it is unlikely that company will take loan and pay the tax. Tax तो कोई भरता नहीं ना, ऐसा तो बहुत रेयर होता है कि you are taking the loan to pay tax, show the more income. Exceptions are there, but usually if dividend and tax data cannot be manipulated or not manipulated, and that represent profitability. If tax and dividend is rising, that means profit is going up, and this profit has to be justified by increasing the sales. Profit आया कहां से? It has to be increased by sales. But why sales is important? Because sometime you see that profit is increasing, but at the same time company might taking the debt as well, and sales is not going up. Sales is, so after the bottom line, top line is important. So two lines are very important, bottom line and top line. So if you learn these two lines, top line and bottom line, most of the valuation game is over, because middle line are here and there complicated. Understanding of middle lines is complicated because some companies have high capex, sometimes some companies have low capex, low employee, low manufacturing cost. Some company have high depreciation and so. But concept of top line and bottom line are same for all. Profit, Bhagwan hai. No profit, no story. And to justify profit, there has to be sales. So घुमा फिरा के आता है sales पे, profit and sales. Okay, let's take one other company, AMC company, ICICI AMC company. So you look for the health parameters, growth parameters. Market capital is 10,000, that's already there. Dividend paying company है, इसका देखते P ratio. It's recently launched, so you don't have a lot much analysis. One more thing, peer comparison. So we always compare with the peer. Let's say you want to, patient wants to decide the surgery. What he will do? He will do the shopping, ask 10 doctors, and then decide who is giving better. So similarly, in stock market, peer comparison is the best way to do the valuation. So valuation are either P ratio, the price based ratio, number one, it is called as relative valuation. Second is comparison, and then next is the third is the calculated values from the other parameter metrics. Easiest way for us is to price based ratio. Don't go into the discount cash flow, etc., but just be aware that it exists. P ratio, PB ratio tells most of the things most of the time. Then what is their margin? See, operating profit margin, interest. So if company is not paying too much interest, means not much debt. So how to find the debts or red flag is from the interest amount here. Okay, and on balance sheet, increasing the debt, borrowing. Okay, third information you see in the financing activity. Okay, here you will also see the interest. So debt will be seen at three places. Can you write what are those three places? अभी तो बोला मैंने. Let's say Hindustan Zinc. How do you find that debt? There is one concept also, interest coverage ratio. It is operating profit divided by interest. But these three you can see debt at three places. One is see the interest in the profit loss, this interest. Second, you see in the balance sheet borrowing, and third you see in the interest again in the cash flow statement. So if you see that interest is more than the profit, then it is risky company. Okay, so you can see that interest, and this is operating cash flow. Okay, so what are the red flag? Red flag in analysis are, we finished. So behavior analysis का 5 मिनट का सिर्फ. In summary, red flags, what? आधे इधर जाओ, आधे उधर जाओ. Reject immediately. That less than 10,000. Actually, I mentioned initially. Another red flags are, write it down, sales declining, operating profit margin decline, debt rising, which will be seen in the form of interest in the profit loss and cash flow as well, and the balance sheet. Okay, then promoter holding is another important red flag. If promoter is selling or pledging the shares, too much pledging is dangerous, because if something happens and the lenders pledge that shares, it will be in a trouble. Anil Ambani has pledged a lot of shares, so this is another thing, it is a red flag. Okay, another thing is that company is receivable and rising unreasonably just to justify the revenue, and cash flow is not there, but profit is, revenue is shown high, but cash flow is not there. That is, on cash flow, operating OIF should be positive, negative, negative. If you see the OIF, that is operating is negative and positive, this is the red flag. Okay, then D ratio, current ratio, return, these things matters. Okay, if growth rates are less than 5, if all these parameters less than 5 or 10 are not in a healthy company. Okay, so I hope you can guess the company analysis based on the various ratios. Now let's focus a few 5 minutes for the mind management. Okay, just 5 minutes. If this thing is getting heavy, overwhelmed, you watch this video again on slow mode, not 2x, otherwise it will again bounce, and do a little practice. Okay, I cannot expect that you should be you should understand everything in a single setting. Okay, it does not. I don't expect that. It will take some time, and you also don't expect that you will learn everything in a single slide, single session. So let's talk about mind management. Here, few things you have to accept, that individuals are incapable of rational decision making. When there is opportunity, people run away, they don't buy. In a market crash, people buy only when there is a mania. So solution to this is to start group trading. It means you create a group of your G10 partners with the PGs and start sharing trades with each other and take approval of each other whether I took the trade right or not. So it will reduce your impulsive buying. Just because of there is a mania, people are buying, you should not enter into that. So group trading is one mind management technique. Now it is up to you whether you want to adopt or not. That is what my suggestion. Group trading, and it works. It works because it reduces the error. Second trick is never deploy 100% capital in equity. So whenever market falls, people get frustrated by two reasons. First, their position in negative, and people like me say buy, 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 and they say paisa hi nahi to kahan se buy. So double problem. So always keep some cash and keep buying. Even if you buy one Nifty share, Nifty base, you are a buyer in a dip. So keep some in your hand. Never deploy 100%. Maybe 90%. At it goes down 90%, but keep at least 10% on equity debt all time. So this is a mind management trick. This may be portfolio rebalancing, but this is a mind management trick. Never deploy 100%. Always keep एक शेयर और डिप हुआ, एक ट्रम्प ने ट्वीट मारा एक शेयर बाय करने का. It help to mind to recondition that I am buying when other people are selling. This is mind. Another trick is, because you know that sometimes knowledge does not help. Even if you are knowledgeable of these things, you have to play the games with your own mind. Next is, do not install broker app in mobile. Invest via browser login. Browser, that means you can log in via internet, kite. You can trade via laptop, so that every time you will not able kya chal raha hai kya. See, just watching portfolio increase only blood pressure. It does not increase portfolio value. So avoid watching portfolio during the day. See in the evening, because anyway market is closed, then you will not be able to. And best is don't use the app, use the browser login, and use two device to log in. For example, what I do, I log in from one device, and that app, the code, authentication code comes to the other mobile. So I need two devices. So it reduces your impulsive buying. And then password. Keep a password such that you will not buy, make an impulsive decision. For example, don't be impulsive. Is it a fear of buying? One of the scholar wrote, keep the password. Wife gets angry while buying. So every time he log in, he get the dose that no, I will have to control my losses. These are the mind hacks. Reminder कि impulsive trade नहीं करना है. Is it fear? These are the password you can keep. Maybe keep some funds in the bank and mutual fund liquid, which is not immediately available for buying. For example, if you buy mutual fund liquid fund, they will give you money next day. So by that time, your impulse will go. Avoid some tips channel or TV telegram channels. They spread the fear. You might have seen in the WealthCon channel since last 2 months. Market everywhere, everyone was selling, sell, 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 panic, panic, doom, doom. We say boom, 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 buy. Okay, these are the mind management tricks. This is another mind management we explain to IMP is TMP is this ATA mind exercise. It's attention tracking awareness augmentation. Many of you are already aware. In a meditation is a word. It's like again sport. Abba dabba chaba, everything can be considered as a meditation. People talk anything in under the meditation. We are not going into that detail. What we are into, it is very specific name. It is attention tracking awareness augmentation, where you just track your attention. You don't judge. You don't try to force your thoughts. You don't have to change anything. You just observe. It can be done anywhere, anytime. You don't have to have any religious belief, dogma, guru, कोई नहीं चाहिए. No one. Guided guidance चाहिए ही नहीं. Guided meditation नहीं है. Music है तो ठीक है, but you don't, even music be not required. Nothing is required. No special preparation. What you need is just sit in a distraction free environment, close eyes, observe the minds, what sensation and thoughts are coming in your mind. Just observe. Just observe. Nothing else. कुछ नहीं करना. कुछ भी नहीं करना. After 3 months, 6 months, you will see the result. Many people have benefited a lot from this simple exercise. There are many other meditation tools. This is similar to the what people teach in the कौन से टेक्निक में करते हैं, विपश्यना में भी यही करते हैं ना, विपश्यना में भी है, बाकी लोग भी यही करते हैं. So this is one mind training tool. I named this attention tracking awareness augmentation. Atta. That means now. Atta in Marathi is now. Just be in a present. See what is going in your mind. Why? How it works. If your time, read the double slit experiment of physics. When you, there is, I think I shown in the previous one, when you see the light particles change the behavior. Light particles change the behavior. So when you observe the thoughts change themselves. Slowly, thought change themselves by just observing. Sensation change their perception by just observation. So two concepts in the quantum physics are very important. One is double slit example and quantum entanglement. Those who are curious, watch this video. It's very interesting. So when you do this exercise, observing thoughts changes automatically by just observation. Do it, automatically happen. And the last is very simple. 1, 2, 3, go. Whenever you want to place the order, type the order. Before clicking the sell or buy, just take 3 deep breath. Deep breath 1, another deep breath 2, another deep breath 3, and after completing, you say go. It creates 10-second gaps between thoughts and action. So this 1, 2, 3 go can be useful in a day-to-day life as well. Even in medical practice, wherever, start using this 1, 2, 3 go. So whenever you want to talk something or some heated arguments, just take 3 deep breaths, 10-second gaps. Your 50% responses will change. 1, 2, 3 go. Similarly, trading 1, 2, 3 go. That means if you are impulsive, automatically it will go down. So these 3 tricks, 1, 2, 3 go, Atta mind exercise, and these are the mind hacks, not the philosophy. I'm not giving any gyan. It is to do how to do. Okay, because how to do is more practical than the giving so much gyan about mind management. You already know it. So just use 3 things. My final recommendation is that be active in a G10 group, because after course is over, we may dissolve the G10 group and then you may not have anyone to solve your queries. As of now, preceptors are there, PGs are there, post scholars are there. Start attending. Again, watch those videos. Even if you are lagging behind, start watching the IMP videos, step on videos you can watch later. Again, last session will be after 1 month, but thereafter you will have additional 1.5 month almost to watch the video revision. Please be aware that we are not going to give extension of video after 30 June. Okay. Am I right, admin? What is the last date?
30th June. Access.
June. June is the last date of video. So last session is on 30th May and last video day is this. We do not give extension. You have enough time to watch those videos. Okay. Thereafter, such extension request, we don't entertain also. Forget giving anything. We just don't entertain. So we are giving you beforehand that you have enough information to learn and watch. In next video, I'm going to discuss about mutual funds. So for passive investing, so I suggest you watch you step one videos. Okay. So next session will be our passive investing. Previous session we discussed swing trading. Today I discussed active investing and the stock analysis. Now I'll finish the passive investing in next live session. Focus on step one videos now. Okay. So thank you very much. And post your comments on experiences in your G10 group, whether you enjoyed this, learn or not learn, whatever it is. And notes, post your notes in the G10 group. We are going to take feedback, how many scholars attended and posted G10 notes. Even if you are not attended, you watch video and then post. Okay. Thank you very much.
Thank you, Ram sir, for this wonderful session. Thank you all the participants for attending it actively. Recordings will be available in WebLMS. Kindly do revise it. You can discuss today's session in your respective G10 group. Thank you and see you all in next live session, that is on 3rd May. And last day of access to all the videos and WebLMS is 30th June. Thank you.